In today's video, I'm going to explain to you how personal income tax works in Canada. I'm going to be breaking down the different components, and hopefully you'll be able to use the information here and take advantage of what's available to you to minimize your overall tax burden. Hi, welcome to my channel. My name is Irene and I'm a CPA here in Canada. I post videos explaining important accounting and tax concepts using simple language to help Canadians better understand accounting and taxes. Make sure you hit that like and subscribe button for more. Before I start the video, I want to preface this by saying that Canadian personal income taxes is a very extensive topic. I'm going to try to keep this video very condensed to prevent any information overload. If you have any questions as you're watching this video, please leave it in the comment section below and I'll get back to you. So let's start off with a super high level review. This is how your personal income taxes work in Canada. So first, you're going to take your total income minus your deductions. That's going to be your taxable income. Once you have the taxable income, your tax rate will get applied on that taxable income to determine your tax liability. In Canada, you'll be able to have tax credits that will help you reduce your overall tax liability that you've been assigned based on your tax rate. After everything is said and done, you're either going to be entitled to a refund or you're going to be owing taxes. I'm going to be breaking down each of these components in details within this video. There are several types of income that is subject to personal income tax. So there's employment income, which is salary and wages. There's investment income like dividends and interest. There is self-employment income, so the income that you generated from operating your own business. There's also rental income, which is the rent that you collect when you rent out your property. Alternatively, you may also incur a business loss or a rental loss. These losses will be applied in this section to help you reduce your overall total income. Please note that Canadians are taxed on worldwide income. This means that, for example, if you were abroad during the year and you made money abroad, you will be taxed on that money that you made abroad if you are still a Canadian resident for income tax purposes. And on a side note, if you're somebody who, let's say, didn't make any money, but you're over the age of 18, it's still highly recommended for you to file a tax return because you'll be entitled to receive different types of tax credits that will be refunded to you. And those get paid out 4 times a year, like the GST, HST credits. I should also note here that the different sources of income have different types of tax treatment. So for example, employment income and interest income gets taxed at the highest. If you receive dividends, depending if they are eligible dividends or non-eligible dividends, you'll get a dividend tax credit to help reduce your overall taxes, which means that dividends are more favorable in terms of tax treatment. This is also similar for capital gains because capital gains are only 50% taxable. So right off the bat, you already cut that in half for capital gains. So next, any deductions that is available to you will be used to help reduce your total income. Some deductions could include union dues, professional dues, RRSP contributions made, spousal support payments. Please note that child support payments are not tax deductible. In special cases, you might be able to claim employment expenses. In order to do so, you must have a form T777 signed by your employer. You may also deduct childcare expenses if you paid for them to, have a nanny or go to daycare while you were working or running your business or going to school. Another expense that you may be able to deduct is moving expenses subject to you meeting the criteria. The criteria include that the purpose of your move was to be 40 kilometers closer to your new work or to your new school location. So after you take your total income minus your deductions, you will arrive at net income. In this next section, you will deduct special items such as non-capital losses of other years, net capital losses of other years, northern resident deduction, etc. After all of that, you will finally arrive at taxable income. So once your taxable income is determined, your tax rate is going to be applied on your taxable income. So in Canada, personal income tax is progressive, meaning that the more income you make, the more tax you'll pay, but it's on a step basis. The federal government will set the federal tax rate for Canada, and each province and territory will set their own provincial tax rate. So there are different tax brackets, and again, the more you make, the higher the tax bracket you'll be in. So the marginal tax rate refers to the tax rate that applies to the next dollar of income that you earn. So over here we have an example, right? So this is Canada's federal income tax rates for 2022. It does not consider provincial tax rates, okay? So basically you can see a few different tax brackets. So on the first $50,197, your federal tax rate is going to be 15%. And then on the next $50,195, so if you make income of $50,197 up to $100,392. That second set of $50,000 is going to be taxed at 20.5%. And then the first set of the $50,000 is still going to be taxed at 15%. So the marginal tax rate is, the tax rate that's going to be applied on that next additional dollar. I will link this resource down in the description box below for you to look at yourself. So once your personal tax rate is applied on your taxable income, that's going to calculate basically your tax liability. However, you may have tax credits available to you to help you reduce your tax burden. So there are two different types of tax credits that can help you reduce your taxes in Canada. One is called non-refundable tax credits, and the other one is called refundable tax credits. Non-refundable tax credits can help you reduce your income tax that you owe, but any unused portion of that tax credit cannot be refunded back to you. So for example, let's say you have a non-refundable tax credit of $1,000. However, you only owe $800 in income taxes. The non-refundable tax credit can bring your total owing to zero. However, you will have the $200 extra, but that will not be refunded to you. Some examples of non-refundable tax credits could include charitable donations and gifts, Canada caregiver amount, Canada employment amount, adoption expenses, medical expenses, tuition and education expenses, interest paid on student loans. I don't want to make this video too long today. I'm thinking of creating a separate dedicated video to this topic. So if I do decide to do that, I'll put it in one of the cards. As for refundable tax credits, these can be used to reduce your tax bill, and any unused tax credits will be refunded to you. So going back to that example, if you had a refundable tax credit of $1,000 and you only owed $800 in income taxes, that additional $200 of tax credits will be refunded to you. Some examples of refundable tax credits include Canada's worker benefit, the GST/HST credits, the eligible educator school supply tax credits. So finally, after applying your tax credits, you will apply any taxes you've already paid during the year. So for example, your income tax deducted. So let's say you have a job and on every paycheck, your employer will withhold that tax from you and they will remit that on your behalf to CRA. The next one is going to be CPP or EI overpayments. Let's say you have two jobs and both jobs were withholding CPP and EI at a specific rate. And it turns out because of the two jobs combined, they were over withholding that amount for you. So you'll get that refunded back to you. However, if you are self-employed, you will actually be responsible for paying the employer portion as well as the employee portion of CPP when you go to file your tax return. And lastly, any tax installments that you've already prepaid during the year, this will help reduce your taxes payable amount, if any. So after everything is said and done, you're either going to be entitled to a refund or you're going to be owing taxes. A common misconception I hear that people say is that they're very happy to get a massive tax refund. Although on the outside it does seem like it is a good thing, however, what it really means is that the CRA withheld too much taxes from you during the year. So effectively, they actually took your money interest-free and just kept it for the whole year, and now they're just giving it back to you basically. Some may also say that there is an opportunity cost because if you get this massive tax refund, you could have used that money during the year and deployed it to make you even more money. Nonetheless, having a tax refund to some people is better than having to pay taxes, so it's really on your own personal preference. Like for example, self-employed individuals, you're responsible for withholding taxes from your business income. If you're not properly planning and tracking, you will likely be hit with a massive tax bill when you come to file your personal taxes because you never paid it during the year and you never set money aside. So it's really important to have a good pulse over that. So the deadline to file your personal taxes is April 30th of the year. However, if you or your spouse or common law partner is self-employed, you both will have until June 15th to file your tax return. However, if you guys owe taxes, your tax will still be due April 30th, even if you don't file your personal tax return until June 15th. Please note that if you are owing taxes and you file your tax return late, CRA is also going to impose a late filing penalty on you, in addition to accruing interest on the late payments. So this all boils back down to having a really good bookkeeping system in place and just being on top of everything so that if you need to make prepayments or estimates, you can go ahead and do that to prevent CRA penalties and etc. So again, Canadian income taxes is a super extensive topic. I barely only touched the surface today. If you have any questions at all, please leave it in the comment section below and I'll get back to you. Thank you so much for making your way until the end of the video. I hope today was helpful. Over here, YouTube thinks that you're really going to like this video, so I'll meet you here.